In the last video, you were introduced to the common account names for both assets and liabilities. In this video, we're going to start with equity. If you've watched my past videos, you already know that equity is the wealth that a business owes to the owners. It is the leftover, residual amount of assets that are left after all the liabilities have been paid. It is made up of only two accounts: what the owners invested in the business, plus all the profit that the business made, which the business has kept. The first account in equity is owner's capital, the amount the owners invest when they started the business. When the business gets cash from their owner, it increases the owner's capital account. It's rare for an owner's capital account to be decreased, so we're going to ignore that right now. The second account in equity is retained earnings, the earnings or profit that will be retained in the business for future development and growth. Retained earnings is always increased by the profit a business makes, and it's always decreased by the dividends that are paid out to the owners from that profit. That's it for the two equity accounts. We only have two more financial reporting elements left, and the next one is revenues. Remember from my previous videos that revenues are earned, meaning the business has done what they were supposed to do for their customers, either provided a service or delivered a good. It's really important to notice that businesses only record revenue in their revenue accounts when their work is done. When they finish their work, revenue is increased, but if they have to refund their customers, then revenue is decreased. There are two main revenue accounts, the first being service revenue, which is used when the business is a service business and provides services like mowing their customer's lawn. When the service is provided, notice the past tense, the service revenue account increases. If the business did not do a good job, then they might have to refund their customer, which will decrease the service revenue account. Similarly, if the business provides goods, then the business will record their revenue in a sales revenue account. When they have delivered the good, the account increases. But if they have to refund their customers money, then the sales revenue account is decreased by the refund. Pretty basic for revenue accounts, so we only have one financial reporting element left: expenses. Remember that expenses are the costs of resources that the business has used, consumed, or incurred in order to help them generate revenue. Again, expenses are only recorded when there are costs that have already happened in the past. The biggest issue is how to record expenses when they happened. Should they be recorded as a plus because they increase, or a negative because they decrease profit? That totally depends on whether the business is using the basic equation or the expanded accounting equation. Check back to Chapter 2 for a refresher if you don't know the answer to this conundrum right now. We won't go through individual expense accounts because they all have the same characteristics. They must be used, consumed, or incurred to help generate revenue. Instead, here is a listing of some of the more common expense accounts, such as advertising, wages, interest, and rent. The number of expense accounts totally depends on what information is needed for decision making. So a business may have many accounts that categorize expenses so they know exactly what the costs of generating revenue is. We have now completed the common accounts under each of the financial reporting elements. In our next video, we'll analyze business transactions using the basic accounting equation and the account names you were just introduced to.